The structure of interest rates deal with how yields or interest rates vary across time at a particular point in time when we are taking that estimate. I would suggest that you read two articles that are attached to this week's Compass website, page 20 and 23 of the Advanced Bond Concepts, and that's the Investopedia article. And then Appendix 5A gives examples of forward and spot rate calculations. Again, what we are looking at is how interest rates or yields change with different maturity. So we are looking at 1 month T-bill, 6 month T-bill, 1 year T-bill, and again, that's how far in the future they mature and how their yields look like as they go off further into the maturity. We will be specifically talking about the Treasury yield curve, no default risk. There is a yield curve for each different risk level. So if we had, for example, AAA bonds, there would be a yield curve similar to the one that's shown on the left of this screen, and it would be higher. There would be an increase in yield to account for risk. Again, we're specifically looking at how yields, interest rates, change across time, and typically we see that yield curve increase as we go in later into the maturities. For example, a 1 month T-bill might have a 0.5 yield. A 1 year would then have a 0.75. A 10-year would have something bigger than 0.75. The yield curve is sloping up. And again, that is typical of yield curves at most times. However, occasionally they vary from that. Again, when you see the typical yield curve and look at it from any website, typically that is based on Treasury notes and bills, and those that are more than a year in length have coupon payments. Just a note here, and we'll come back to that point often. Here is an example of a yield curve. This has two yield curves on it. The black is 1 year ago, and the blue is the current yield curve. So if you look at the blue current yield curve, it has the typical shape. 1 month all the way over to the left has a low interest rate. In this case, it's 0.25 or probably lower than 0.25. 3 month has a bit higher, 6 month higher, 1 year has higher, and then it goes up as we increase the maturity. Again, here, this 30-year note, that will be the end of the note, and that's when we get both the par or principal and a final coupon payment. This black line is from a year ago. So if you were looking at a year ago and today's yield curve, you would say it has come down. And it's probably, if you look at it, steepened. So if you're looking at interest rates or yields into the future, they have gotten higher. All right. We're going to talk about this yield curve and what it implies for interest rates in the future.